Our lecture series on New Principles of Economics, the Science of Markets, continues with Chapter 13 about economic fluctuations and aggregate economic evolution. We will explain the causes of fluctuations and policy measures aimed at managing them.
The study of economic fluctuations, commonly known as business cycles, is an important topic in macroeconomics, which is distinct from microeconomics. This area of economics has significant visibility in the public sphere and a strong influence on policy making. Economic fluctuations are a common characteristic of markets when considered at the aggregate level of measuring economic activity and performance.
Following the financial crisis of 2008, many prominent macroeconomists raised significant doubts about the state of their field. The public generally shared these sentiments, recognizing that macroeconomists failed to anticipate the crisis. Since then, economic policies, particularly monetary policy, have explored new and untested approaches, including so-called quantitative easing.
We present a new approach to economic fluctuations that combines insight from two of the most influential economists of the past century, Joseph Schumpeter and John Maynard Keynes. From Schumpeter, we take the emphasis on the role of innovation and technological change. From Keynes, the focus on expectations. We combine their analysis with more recent developments in scrutinizing the role of institutions in shaping fluctuations, such as the French Regulation School.
The chapter proceeds as follows. We begin with a brief glance at Schumpeter's famous analysis of fluctuations as interferences between cycles of different length and amplitude. His views have been endorsed by more recent approaches in linking technological and institutional changes through time. We frame this by the concept of techno-institutional regime, which can be employed on different levels: global, national, and subnational, as well as sectoral. Fluctuations arise from tensions across those regimes, which evolve with different speeds and scope.
We will continue by emphasizing the critical role of accounting balances across various markets, focusing on the changing budget constraints faced by different economic actors and sectors, as well as their temporal structures. A key aspect to consider is how market conditions are transmitted between different markets, including wage constraints that arise from imbalances in the labor market and demand constraints affecting consumer goods markets.
The second key concept is the expectations that develop in markets due to continuous information processing. We reject the rational expectations hypothesis, which has dominated macroeconomics for decades. But we also steer clear of overly simplistic views on irrationality. Instead, we advocate for an empirical approach to understanding expectations. This approach distinguishes between individual-level expectations and those that arise collectively among networks of market participants, while also exploring the various mechanisms through which these expectations emerge.
Next, we will examine in greater detail the factors that explain economic fluctuations. One key factor is innovation and entrepreneurial dynamics, which drive changes in productivity, as well as the process of creative destruction, a term popularized by Schumpeter. These dynamics significantly influence expectations in the economy. Entrepreneurs often require external financing, which creates a strong interaction with developments in the financial sector. The overall result is a credit cycle characterized by periods of booms followed by busts, with leverage playing a crucial role. Additionally, we will highlight the importance of financial innovation as a form of entrepreneurship.
Fluctuations are a major concern in modern economic policy. We examine two components, monetary policy and fiscal policy, both of which highlight the importance of expectations and their management. Consequently, along with the influence of statistics on public perceptions of these fluctuations, it becomes clear that policies are highly performative.
We conclude by presenting a framework for analyzing fluctuations as manifesting shifting market states in systems of interconnected markets.
Joseph Schumpeter, like many early theorists of business cycles, believed that business cycles vary in length and are influenced by different factors, such as technology in the long run and market dynamics in the short run. These cycles overlap in actual fluctuations, creating a unique pattern. Additionally, Schumpeter proposed that cycles exhibit a regularity that accounts for the distinct wave-like shape.
The Schumpeterian school later expanded to develop detailed ideas regarding the interaction between technological innovation and institutional change. From them, we derived the concept of a techno-institutional regime.
This term can't be found in standard macroeconomics.
Indeed, the analysis of techno-institutional regimes is closely related to historical methods. Yet, it is also grounded in solid statistical work. This concept integrates several other ideas, such as technological paradigm shifts, like the diffusion of electricity or more recently, artificial intelligence, as well as the policy framework within the broader context of institutions.
A famous regime is that of Fordism, which combines technologies of mass production with mass consumption, and a Keynesian demand management policy framework which shaped the post-war golden age.
We can identify different national variants of Fordism, such as the French and German models, as well as subnational patterns where a specific industry may dominate a particular region. However, the concept of Fordism does not imply that this regime has the same characteristics across all sectors. Consequently, we find a complex landscape in which various sub-regimes coexist, often with different timeframes. The fluctuations in these regimes result from their interactions with one another.
Sometimes, significant sub-regime changes occur simultaneously across various spatial and sectoral units, or a dominant sector sub-regime changes can influence all other sub-regimes, as seen in finance. These convergent mechanisms may lead to crisis.
Yes, this perspective on fluctuations differs from the early mechanistic wave model. It emphasizes that the length of fluctuations varies depending on the stability of existing regimes, the depth and impact of regime changes, and specific patterns of causality, such as whether they are endogenous or exogenous.
Let's now examine how fluctuations are transmitted through specific mechanisms. The standard framework of national accounts is crucial because it creates a closed system in which all financial flows must balance, unless we are discussing an open economy, which will be addressed in the next chapter. National accounts enable us to understand aggregate effects and processes.
How does this match with our approach in previous chapters?
Well, for example, it is essential to consider the diversity of different groups, as their responses to changing budgetary constraints can vary significantly. For instance, we know that wealthy individuals tend to have a different propensity to consume than those with lower incomes. While mapping the economy at an aggregate level is useful, it should not obscure our understanding of how specific markets are interconnected or highlight dysfunctions or the absence of certain markets. The conventional high level of aggregation in recent macroeconomic models often conceals important aspects of the real-world mechanisms that drive economic fluctuations.
A general theoretical framework involves the mechanism of accounting balances. This means that a change in one market can impact other markets through their budget constraints. A clear example of this is rising unemployment in the labor market that affects the budget constraints of consumers, which in turn influences the consumer goods market. This situation also illustrates the importance of institutions, such as the system of unemployment benefits.
So, temporal aspects matter.
Yes, speeds of adjustment may differ across markets, and we also need to consider financial mechanisms that allow to allocate budget constraints over time. Most importantly, time comes into play when we consider the distinction between planned and realized accounting balances. If these converge through time, an equivalent to equilibrium emerges, meaning that people don't see the need to adjust their plans. If the two diverge, expectations about an uncertain future will become crucial for coordination across markets.
The theory of expectations is one of the most contested in macroeconomics. There is a wide spectrum that reaches from assuming plain irrationality to perfect rationality. Over the past decades, the rationality assumption prevailed, which has the interesting consequence that the observer's views are collapsed into one. The rational individual would have the same data and models as the scientific observer, and different rational individuals would therefore agree on the state of the economy.
We reject this view, beginning with the classical error information paradox. Individuals cannot employ a rational cost-benefit calculus on the activities of information processing because they can never know what is lost when they stop. Also, as in financial markets, information sharing is constrained by similar considerations. So we do not assume that economic actors can converge on a shared third-person view of the economy.
Based on our previous chapters on individual behavior, cognition, and networks, we suggest a more complex but empirically sound approach to expectations. The first observation is that individuals form expectations by giving reasons. This also applies to the use of the tools of economics, such as risk scenarios. They are reasons, but not primarily approximations to reality.
We also combine cognitive and emotional factors, which implies that context matters beyond the direct economic data. And we consider the fact that certain types of actors form their expectations starting out from broader visions of the future, especially many entrepreneurs. These visions are not mainly intended to describe reality, but possible futures, hence are fictions.
As we see, many elements of this approach to individual level expectations point towards the collective level. Keynes' famous metaphor of the beauty contest reveals that individuals cannot effectively decouple from the collective level, since they cannot treat them like an exogenous parameter. Most importantly, they must always form expectations about the expectations of others. And this includes the reciprocal process.
Much of our analysis of networks and information externalities relates to collective expectations. Individuals exhibit certain behaviors, which generates information for others, although this does not mean their true underlying expectations are revealed. Behavioral data can be aggregated, allowing individuals to form expectations based on the collective viewpoint. These interactions can lead to strong behavioral coordination, as seen in phenomena like herding in financial markets, where the majority of participants move in the same direction.
There are many distinct network effects that affect information transmission and observability. For example, some individuals with high status may strongly affect the expectations of many others, or some information may only diffuse in closed circles of actors.
One example of influential individuals as opinion leaders is entrepreneurs who are highly visible publicly.
Yes, and this brings us to our next topic, the driving factors behind economic fluctuations. According to the Schumpeterian tradition, entrepreneurial innovations serve as the engine of a market economy and often occur in waves, as they tend to cluster together. A prime example of this phenomenon is the recent boom in artificial intelligence.
The entrepreneurial process is dynamic and resembles a wave. Initially, an innovator may enjoy monopolistic profits, attracting competitors to enter the market. As more competitors join, the market approaches saturation, often resulting from an overabundance of new entries. Eventually, this leads to market consolidation due to intense competition and natural selection among businesses.
There is a direct connection between the dynamics of entrepreneurship and the role of the financial sector in creating economic fluctuations. Entrepreneurs typically require access to external financing, but they also face constraints due to the high risks associated with investing in innovations. Despite these risks, the potential for substantial profits can attract risk-seeking investors. As a result, financial investors can significantly promote innovation, thereby boosting economic activity. Additionally, factors such as herding effects, information externalities, and a general fear of missing out further accelerate the boom in this environment.
We incorporate the financial mechanism of leverage. External financing can significantly enhance the return on capital that is funded internally. However, this also increases the risk of bankruptcy, especially when costs are high. These risks are somewhat alleviated by the fact that asset values tend to rise during economic booms, which reassures providers of external financing. A classic example is the housing cycle, where the increasing value of real estate facilitates access to external financing because it is viewed as a safe form of collateral.
And the leverage cycle then also works in the opposite direction, when deleveraging becomes necessary. This is the classical credit cycle, which is generated by endogenous mechanisms of finance.
Another endogenous mechanism is financial innovation. The housing cycle was intensified in the 2000s because of the widespread use of mortgage-backed securities. Financial innovation is an entrepreneurial process sui generis with a similar dynamic.
In summary, the interaction between entrepreneurial dynamics and developments in the financial sector serves as a driving force for endogenous fluctuations in the economy. After a period of economic boom comes a bust. This is associated with a shift in collective expectations which can possibly be triggered by single events that exposes the fragility of the boom. This shift can be painful and involves changes in the financial sector, particularly the move towards credit rationing. In this scenario, financial institutions prioritize safety over flexibility and are less responsive to offers of higher interest rates.
Reviving the economy can be quite challenging, especially if the previous boom was rampant. It can require significant entrepreneurial drive and a breakthrough innovation, which are both uncommon occurrences. Or we see an unexpected event that dramatically changes the expectations of economic participants. Finally, economic policy can also play a significant role.
Indeed, Keynes' legacy is the belief that only the government can effectively reinvigorate the animal spirits of the economy. After the Second World War, many economists recognized the government's critical role in managing economic fluctuations.
This view was bolstered by the development of modern aggregate statistics of economic activity, with GDP as a central term. Before that statistical innovation, economic actors had no quantitative view of the aggregate patterns of economic evolution.
Does this offer an objective view on the economy?
Well, we already explained in chapter 2 that GDP only manifests a second person but not a third person view, since it necessarily relies on shared subjective valuations, primarily market prices. We also mentioned that GDP measurement relies on numerous problematic assumptions and conventions, for example, with respect to its ignorance of environmental conditions. Indeed, addressing pollution contributes to GDP. An example that is particularly relevant for our topic here is the measurement of the financial sector, where statistical conventions imply that it contributed to GDP during the financial crisis of 2008 and its aftermath. The reason for this is that financial adjustments and corrections are considered to add value to the financial business, even if the source of the disorder originated exactly there.
Nevertheless, economic actors read the statistical news and respond to them. Hence, there is a strong performative effect here. For example, an increase in GDP may foster the belief that the economy is strong and generate corresponding behavioral consequences.
Special effects can arise from the timing and frequency of statistical publications, as well as from the different geographical scopes of the statistics. For instance, in a large country like China, there can be significant regional variations in economic activity, which makes national data less meaningful. However, foreign investors might still react to these national averages.
Modern economic policy relies greatly on macroeconomic statistics, which economic actors use to evaluate and respond to various policies. There are two main components of macroeconomic policy: monetary policy and fiscal policy, distinguishing them from the other, more disaggregate type of policies like social redistribution. Among these, monetary policy represents the most direct form of intervention through highly aggregate measures.
Modern central banks in advanced economies are primarily designed to function as independent technocratic institutions, focusing on managing the money supply and controlling inflation. In addition to these core responsibilities, they may also have regulatory tasks. Central banks can pursue additional goals, such as maintaining a high employment rate. The debate surrounding the role of central banks is ongoing, and there are times when governments challenge their independence, as recently seen in the US.
Neoclassical purists have often argued that money is merely a veil that does not have a lasting impact on the real activities of the economy aside from determining the price level. We have already contested this view in our account of money in chapter 10. Today, most economists agree that monetary policy can have real effects. The channels through which these effects occur are complex and variegated.
It seems that modern central banks increasingly manage economic expectations through communication about monetary policy.
They have learned that the effectiveness of specific interventions largely depends on how economic actors respond. For instance, lowering interest rates to stimulate investment is not an automatic process. Investors may doubt its efficacy or anticipate that the policy will not last long, especially if they perceive an environment leaning towards inflation, such as in cases of high government debt.
Indeed, some economists argue that monetary policy should adhere to strict and simple rules, minimizing the discretion of central bank leaders. Additionally, it is noteworthy that economists often identify a gap between the rhetoric used by central banks to manage public expectations and the actual policies implemented afterwards.
This discussion must also recognize that monetary policy operates within broader institutional frameworks, including the organizations responsible for wage negotiations and how wages respond to overall economic conditions. Additionally, a well-defined policy objective necessitates coordination with other policy areas. In particular, fiscal policy can hinder the effectiveness of monetary policy.
As said, fiscal policies can be viewed in a broader context that includes various forms of state intervention. Even when we consider the aggregate level only, fiscal policy becomes more complex due to the different degrees of intervention and automatic transmission mechanisms available. For instance, a progressive tax system has automatic effects during a period of economic expansion when more individuals move into higher income brackets.
When it comes to discretionary policies, we face a similar issue with expectations as we do with monetary policy. Economic actors may foresee the future effects of policies that could undermine their current objectives. For instance, if taxes are lowered today and government debt is increased, economic actors might anticipate significant changes to tax policy in the future. As a result, they would factor this potential shift into their decisions today, which could have long-term consequences.
This is the famous Ricardian equivalence theorem that argues against the effectiveness of a Keynesian expansion of government debt to boost the economy, which rests on a different behavioral model where consumers just spend a fraction of their regular income.
As we see, there are many complex issues related to the time horizon and specific structure of fiscal policies which interact with the expectational horizons of different actors. Ricardian equivalence assumes that individuals consider the long-term implications of fiscal measures. While this may hold true for wealthy investors, it often does not apply to low-income workers. Generally, a key distinction between taxes and debt is that governments can distribute fiscal burdens across different generations. This can be justifiable, for example, if current investments in infrastructure primarily benefit future generations.
A particularly important topic in this context is the political business cycle. When fiscal policy is not constrained by fixed rules or legal requirements, it allows for discretionary measures that are often aimed at winning voter support. Incumbents and challengers may propose various policies for the upcoming term, with the fiscal impact becoming apparent only in later terms. In the short run, incumbents might distribute benefits to the electorate as election day approaches. However, the effectiveness of such policies again depends on the behavioral reactions as well as the time preferences of the electorate.
Fiscal policy in multi-level jurisdictions is a specific area of focus. Typically, only national governments have the authority to issue debt. However, in larger countries, economic conditions can vary significantly across different regions. This variation suggests that it might be beneficial to allow lower-level governments to issue their own debt. Limited fiscal capacity of lower levels can necessitate the creation of complex systems of fiscal redistribution.
Finally, we have already mentioned the potential for tensions between fiscal and monetary policy, which underlines the case for strong institutional constraints and reliable rules.
In principle, the separation between the two is a fiction. Since in systems based on sovereign money, we could also speak of a unified budget constraint of government that includes its capacity to create money as a legal tender. Indeed, historically, a means to push the monetization of the economy was to oblige people to pay tax in the money issued by the sovereign.
Governments can always ease their budget constraints by printing money and can reduce the real value of government debt by inflating the price level.
However, this comes at the cost of inflation and eventually a loss of trust in money and government institutions. Ultimately, fiscal expansion would undermine the foundations of a market economy.
Let us review our overall approach. We will refer to the concept and diagram of the market state introduced in Chapter 11. In our techno-institutional regime framework, we argue that regimes can vary in diversity, scope, and temporal structure. Additionally, we can analyze how economic forces propagate across markets through the interfaces at different nodes of the market state diagram. Two key connectors and mediators in this process are accounting balances and expectations.
We previously discussed the important example of the interaction between the labor market and the consumer goods market, represented by the red and green circles in the diagram. We can analyze the state of each market. Let's assume that in the labor market, a specific combination of expectations and market clearing results in unemployment. For instance, if employers judge the wage level to be too high, they may develop pessimistic expectations, which can be shared by employees facing unemployment.
I see. And then the accounting balance mediator affects the market clearing in the consumer goods market because employed consumers and the unemployed both tend to consume less, resulting in a demand shortfall.
Which then further darkens the outlook of the producers in the labor market, who further cut employment, running the economy all the way down.
Another example to consider is how consumer expectations regarding changes in price levels can influence market clearing. For example, when consumers anticipate inflation, they may postpone their purchasing decisions. This behavior can have significant effects on the goods market, which is closely linked to the financial sector. However, these markets operate with different structures, resulting in varying response times for prices and the resulting transaction flows. Typically, financial sector transactions occur much faster than transactions in other markets, where prices tend to be sticky. This stickiness is often due to strong disincentives against frequently and abruptly changing prices.
In summary, economic fluctuations are heavily influenced by the historical context and exhibit complex patterns of cause and effect. There are significant internal forces at play, particularly concerning how expectations are formed. Interactions occur at various levels of aggregation and across different time frames. Market signals and forces tend to have a significant impact in the short term, while institutional changes typically influence the medium term. Meanwhile, shifts in economic regimes tend to unfold over the long run.
What do we take home? Economic fluctuations are embedded in techno-institutional regimes, which encompass technological paradigms as well as institutional principles and their constituent sub-regimes. Concrete patterns of fluctuations are influenced by the co-evolution of sub-regimes, with concurrent changes in several sub-regimes commonly leading to a stronger fluctuation amplitude.
A temporal analysis of accounting balances on different levels of aggregation can account for the historicity of economic fluctuations as well as common patterns. Expectations, as formed both on an individual as well as collective level, are the key subjective determinants of economic fluctuations.
Monetary and fiscal policy are performatively shaped by the use of economic statistics and macroeconomic modeling. Their effectiveness in stabilizing fluctuations depends on complex interactions with economic agents in terms of credibility and expectations formation. The institutional separation between monetary and fiscal policy is a specific component of post-war regimes in Western Europe and has been instrumental in keeping up the narrative of a market system.
Economic fluctuations can be triggered by technological and institutional change as well as by financial sector instability, resulting in typical boom and bust cycles. Fluctuations manifest shifting market states in complex systems of interconnected markets where expectations and accounting balances transmit economic forces at different speeds and with selective causality. Hence, fluctuations are path-dependent phenomena.
Our analysis in this chapter did not include the interaction between economies on the global level. This is the topic of the next chapter.
We hope to see you again.
Thank you for your attention and goodbye.